Debt Report, 2021. Edition 1. About the report. This is the first of the series of debt reports for 2021 to be published online, at regular intervals, over the course of the year. Their aim is to provide users with analyses of evolving trends and development related to external debt and public debt in individual countries and regional groups, with primary emphasis on low and middle income countries, and to keep users abreast of debt-related issues and initiatives. The reports complement the summary overview of borrowing trends in 120 low and middle income countries. Information presented in International Debt Statistics (IDS 2021), published in October 2020, with regional and country-specific analyses on the composition and characteristics of external debt stocks and flows. The analyses will be underpinned by the detailed loan-by-loan data on stocks, transactions, commitments, disbursements and debt service payments, and loan terms captured by the World Bank Debtor Reporting System (DRS), draw from the high-frequency, quarterly external debt statistics (QEDS), and quarterly public debt statistics (PSDS) databases to provide users with syntheses of emergent trends in external and public debt, including borrowing patterns and current debt levels in both high-income countries and low- and middle-income countries, provide users with information briefs on current issues and ongoing initiatives aimed at improving external and public debt measurement and monitoring, filling data gaps, and enhancing the coverage and harmonization of international datasets and related data dissemination. Debt Report 2021 edition I presents a summary analysis of the composition of external debt stocks and flows from a regional perspective and draws out the main messages of the regional and country-specific data available to users at https://data.worldbank.org/products/IDS. Regional Overview 2019. Financial flows to low and middle income countries fell for the second consecutive year in 2019. Aggregate net financial flows, debt and equity combined, totaled $0.9 billion in 2019, 15% lower than the comparable figure for 2018. Measured relative to borrower countries' GNI, aggregate financial flows were equivalent to 2.9%, a marked decrease from 3.5% in 2018 and well short of the 6.9% recorded in 2010. The downturn in net financial flows was the result of a 28% drop in net debt inflows, gross disbursements of new loan financing minus principal payments, which fell to $383 billion from $531 billion in 2018. The contraction in net debt inflows contrasted with equity inflows, which remained stable. FDI inflows, long considered the most resilient and least volatile component of financial flows, totaled $471 billion, down marginally from the 2018 level, whereas portfolio equity inflows rose 24% to $48 billion. Figure 1. Net financial flows by regional distribution, 2019. Total external debt stocks of low and middle income countries rose 5.4% in 2019 to $8.1 trillion, a rate of accumulation almost identical to that of 2018 but close to half the 10.5% rise in external debt stock recorded in 2017. The increase in debt stocks in 2019 resulted from net debt inflows of $383 billion and valuation changes in year-on-year exchange rates in relation to the US dollar. Around half the external debt of low and middle income countries is denominated in currencies other than the US dollar. Long-term external debt grew at the fastest pace, rising 7% to $5.8 trillion, equivalent to 71% of total external debt stock. Short-term debt rose marginally, 1.5%. In common with debt flows, the accumulation in 2019 external debt stocks was driven by China, which accounted for 26% of the combined end 2019 external debt stock of low and middle income countries. China's long-term external debt stock rose 23% in 2019 to $900 billion, while short-term debt fell by a little over 1% to $1.2 trillion. Excluding China, the external debt stock of low and middle income countries rose on average 4.7% in 2019, but with wide divergence at the regional level. Countries in Sub-Saharan Africa recorded the fastest accumulation in external debt stocks in 2019, on average 9.7%, followed by those in the South Asia region, 7.6%. Conversely, in Latin America and Caribbean countries the pace of external debt accumulation slowed to 2.3%. East Asia and Pacific. Net financial flows totaled $418 billion in 2019, a decline of 34% from the prior year, reflecting the sharp 39% contraction in debt and equity flows to China. Net financial flows to other countries fell on average 12% in 2019. Table 1. External debt stock and net financial flows, East Asia and Pacific, 2010 to 2019. The volume and trend of net aggregate financial flows was determined by China, which accounted for 77% of the combined debt and equity inflows to countries in the region in 2019. Aggregate financial flows to China fell 39% in 2019 to $320 billion from $522 billion in 2018 after a 29% reduction in net equity inflows and a steeper 48% reduction in net debt flows. The underlying factors that drove the level and composition of financial inflows to China are discussed in the overview section of IDS 2020. Excluding China, net financial flows to other countries in the region fell, on average, 12% in 2019, with a 17% increase in net equity inflows, which was not enough to offset the 33% fall in net debt inflows. Net debt inflows totaled $43 billion, of which 54% was accounted for by Indonesia and a further 24% by Vietnam. The rise in equity inflows was driven by a record level of FDI inflows to Indonesia, $25 billion, up 24% over the prior year, with strong investment in manufacturing, mining, and financial services. Among the small economies, Cambodia received record-high FDI inflows of $3.7 billion in 2019, led by increases in manufacturing and services by predominantly Asian investors. FDI in Thailand fell 60% to $5.3 billion and 14% in Vietnam to $12 billion. Figure 3. Net debt and equity inflows EXCL. China, 2010 to 2019. Net debt inflows to the region fell 45% in 2019 to $187 billion due to a 30% drop in long-term debt inflows and a $13 billion outflow of short-term debt. Driving these outcomes was a 48% fall in debt flows to China, where a sharp 81% rise in long-term debt inflows to $158 billion was offset by the sharp contraction in short-term debt flows. Net debt inflows to other countries in the region fell less than those to China, 33%, but with the pattern of flows reversed. Long-term debt inflows fell 38% to $42 billion, whereas short-term debt flows were positive, with an inflow of $0.8 billion as compared to an outflow of $4.2 billion in 2018. The downturn in long-term debt inflows was principally due to the drop in those from commercial banks and other private entities. They contracted sharply to $7 billion, less than a quarter of the comparable figure in 2018, largely on account of the collapse in inflows to non-guaranteed private sector entities in Thailand, which fell to around $60 million from $17.4 billion in 2018. In contrast, inflows from bondholders rose 4% to $31 billion, spurred by a record $23 billion in new issuance by public sector entities in Indonesia. Long-term inflows from official creditors to the region excluding China fell 39% to $3.6 billion, driven down by a contraction in inflows from bilateral creditors, while the official creditors' share of long-term debt inflows remained moderate, 8%. Figure 4. Creditor composition of net debt inflows excluding China, 2010 to 2019. The region is home to 15 of the world's poorer countries eligible for the Debt Service Suspension Initiative, DSSI, including several small Pacific Island states with a combined external public debt stock of $44 billion at end 2019. On average, 56% of the end 2019 debt stock was owed to bilateral creditors, 27% to multilateral creditors, and the remaining 16% to private creditors including bondholders, commercial banks, and other private entities. The volume and composition of debt stocks at the individual country level was divergent. Myanmar was the largest debtor in the group, with an end 2019 external debt stock of $11 billion, followed by Laos PDR of $10.4 billion, Mongolia $8.4 billion, and Cambodia of $7.7 billion. Over 70% and 80%, respectively, of the end 2019 debt stock of Cambodia and Myanmar was owed to bilateral creditors, whereas Papua New Guinea owed the largest share to multilateral creditors, 45%, and Mongolia owed 43% to private creditors. Regarding the creditor composition, China accounted for nearly 58% of bilateral debt stocks, followed by Japan with 20%. The Asian Development Bank was the largest multilateral creditor, accounting for 52% multilateral debt stocks, including the IMF, followed by the World Bank, 35%. Figure 5. DSSI eligible countries composition of external public debt stock, end 2019. Europe and Central Asia. Net financial flows rose to $93 billion in 2019, a marked turnaround from the $19 billion outflow recorded in 2018. The rebound was driven by inflows to Russia but was mirrored in an increase in debt and equity inflows to several other countries in the region in 2019. Table 2. External debt stock and net financial flows, Europe and Central Asia, 2010 to 2019. Net debt flows to the region totaled $30 billion in 2019, a marked contrast to the $57 billion outflow recorded in 2018. The outcome was driven by Russia, which accounted for 47% of the 2019 net debt inflows to the region and saw debt flows swing from an outflow of $64 billion in 2018 to an inflow of $14 billion in 2019, with short-term debt flows of $9.4 billion accounting for two-thirds of the total. The main driver of the turnaround in Russia's long-term debt flows was a threefold increase in new bond issuance by public and private sector entities and marked slowdown in outflows to commercial banks, which declined to $32 billion from their 2018 level of $56 billion. Debt flows to Turkey, the region's second-largest borrower, continued their downward trajectory, with the net outflow widening to $3.7 billion from $2.8 billion in 2018. A rebound in short-term debt inflows to $6.6 billion in 2019, compared to the prior year outflow of $3.4 billion, was not enough to offset long-term debt outflows of $10.3 billion, largely the consequence of the sharp rise in outflows to commercial banks from non-guaranteed private sector borrowers. These widened to $12.8 billion in 2019 from $3 billion in 2018. Long-term flows to public sector borrowers fell 14% to $4.4 billion, notwithstanding $11.6 billion in new bond issuance. Figure 6. Net debt inflows by creditor type excluding Russia, 2010 to 2019. Countries in the region, other than the two largest borrowers Russia and Turkey, saw debt inflows double in 2019 to $19.5 billion on the back of a renewed short-term debt inflows and rebound in long-term debt flows. Short-term inflows totaled $4.1 billion, a marked turnaround from the 2018 outflow of $0.4 billion, driven in large part by $0.5 billion to Uzbekistan, $1.2 billion to Ukraine and $0.7 billion to Belarus from outflows of $0.1 billion, $2.1 billion and $0.2 billion, respectively, in 2018. Net long-term debt inflows rose 51% in 2019 to $17.3 billion, driven by a surge in inflows to non-guaranteed private sector entities. Several countries including Belarus, Bosnia-Herzegovina, Serbia and Uzbekistan, primarily intercompany lending facilitated by commercial banks but including some bond issuance by private entities. As a result, private sector entities absorbed 64% of long-term debt inflows, up from 28% in 2018. Long-term debt inflows to public sector entities totaled $6.2 billion in 2019, of which Uzbekistan accounted for 38%. It recorded a 25% increase in inflows to public sector entities in 2019 to $2.4 billion, of which over 95% was from official lenders, including $0.8 billion from the World Bank. Figure 7. Net debt flows to public and private entities in select ECA countries, 2018-2019. The region recorded the largest rise in FDI inflows in 2019 of all low and middle income countries. FDI inflows increased by 50% to $67 billion, propelled by a rebound in FDI inflows to Russia. They rose nearly threefold to $29 billion from $10 billion in 2018, with reinvested earnings topping $20 billion and new investment turning positive, after large-scale disinvestment in 2018. Other countries in the region saw FDI inflows rise on average 10%, led by a resurgence in inflows to Kazakhstan, which rose 153% to $6.7 billion from Chinese, Russian and U.S. investors. Mining of metals attracted the largest volume of investment, followed by projects in the manufacturing sector. FDI inflows to Uzbekistan more than tripled to $2.1 billion in response to measures aimed at economic liberalization, which attracted Asian and European investors into a range of projects including chemical production, uranium exploration, and the textile industry. Some of these inflows also related to a large ongoing project by the Russia's Lukoil. FDI increases across the region served to offset the 14% contraction in inflows to Turkey, triggered by greater economic uncertainty, weaker economic growth, and the country's exposure to global economic conditions which weighed on investor sentiment. Figure 8. Foreign direct investment in select countries, 2018-2019. Latin America and Caribbean. Net financial flows fell 38% in 2019 to $173 billion, their lowest level in a decade, measured in relation to GNI. Equity inflows held up, rising on average 8%, but were insufficient to offset the 72% downturn in net debt inflows. Table 3. External debt stock and net financial flows, Latin America and Caribbean, 2010-2019. Aggregate net financial inflows to the region fell 38% in 2019 on account of the fall in net debt inflow to $45 billion, the lowest level of the decade and significantly below the $161 billion recorded in 2018. In contrast, net equity flows rose 8%, underpinned by foreign direct investment inflows which remained stable in most countries and increased, on average, 9% in 2019 from the prior year level, offsetting a $1.3 billion widening in portfolio equity outflows. The Big Three, Argentina, Brazil and Mexico, accounted for 85% of net financial flows to the region in 2019 and drove the overall volume and direction of flows. The contraction in net debt inflows to Argentina and Brazil to $9.8 billion in 2019 from $123 billion in 2018 was the major factor in the regional downturn, and only marginally offset by the 47% rise in comparable debt inflows to Mexico to $20 billion. Equity flows fared better, with the combined inflows to Brazil and Mexico rising on average 13% in 2019 to $70 billion and $34 billion respectively. Those to Argentina rose by 35% to $12 billion. Other countries in the region recorded a 36% decline in net financial flows in 2019 to $27 billion, with a 38% fall in net debt inflows and a 36% fall in net equity inflows to $11.6 billion. Figure 9. Net debt and equity inflows to select countries, 2018-2019. The precipitous fall in long-term debt flows in 2019 was triggered by a contraction in those from private creditors to both public and private sector entities. Net long-term inflows from private creditors fell 83% in 2019 to $14 billion, driven by an 86% fall in those to public sector entities, largely bondholders, and a corresponding 78% fall in those to non-guaranteed private sector entities, primarily commercial banks and other private entities. The $42 billion reduction in net inflows from bondholders to Argentina from $31 billion in 2018 to an outflow of $11 billion in 2019, and the $26 billion outflow from Brazil's private sector entities to commercial banks were key elements of this outcome. Other countries in the region, excluding Argentina and Brazil, saw net inflows from private creditors rise 83% in 2019 to $28 billion, of which Mexico accounted for $18 billion. Net inflows to the region from official creditors totaled $18 billion in 2019, close to half the comparable figure for 2018, with $24 billion in net inflows from multilateral creditors offset by an outflow of $6 billion to bilateral creditors. Inflows from multilateral creditors included disbursements of $16.2 billion to Argentina from the IMF in the context of the bailout package agreed in 2018. Net inflows to other countries in the region, $7.5 billion, were 9% below the prior year level, but those from the World Bank rose 25% to $2.2 billion. Figure 10. Composition of long-term net debt inflows, 2017 to 2019. Net inflows from bondholders fell 63% in 2019 to $16 billion as a result of a downturn in new issuance and a sharp rise in repayment on maturing bonds. Bond issuance by public and private sector borrowers fell to $82 billion in 2019, a 13% decline from the comparable figure for 2018. New issuance by public sector borrowers fell 20% from the prior year level due in large part to the steep contraction in issuance by Argentinian borrowers to $7 billion, from $44 billion in 2018. This was partially offset by a $12.4 billion increase in issuance by public sector borrowers in Mexico and $4 billion by those in Brazil. In contrast, new issuance by private sector borrowers in the region, $23 billion, was 9% higher than the level attained in 2018, largely on account of $12 billion in bonds issued by private sector entities in Mexico, up sharply from the comparable figure of $6.9 billion in 2018. Repayments on maturing bonds were an important element of the downturn in net flows. Principal repayments on maturing bonds issued by public sector borrowers rose 77% in 2019, reducing net inflows to $13 billion, $48 billion in 2018. In contrast, principal payments on maturing bonds issued by private sector entities fell 20%, resulting in a net inflow of $2.9 billion as compared to an outflow of $4.2 billion in 2019. Figure 11. Bonds by borrower type. Gross and net flow, 2018-2019. Middle East and North Africa. Net financial flows fell to $36 billion in 2019, their lowest level since 2015 and 16% below the comparable flows in 2018. This downturn was the outcome of a 46% contraction in net long-term debt flows driven by sharp fall in flows from private creditors. Table 4. External debt stock and net financial flows, Middle East North Africa, 2010-2019. Aggregate net financial inflows to the region fell 16% in 2019 to $36 billion, their lowest level since 2015 due to a sharp, 23% contraction in net debt inflows and a more moderate, 8% downturn in net equity flows. The downturn in net debt flows was driven by a 46% contraction in long-term debt inflows, which fell to $15.6 billion, from $28.7 billion in 2018, and more than offset short-term debt inflows. The fall in long-term debt inflows was driven by the sharp reduction in inflows from private creditors, which fell to $6.9 billion, less than one-third the 2018 level. In contrast, net inflows from official creditors rose 43% to $8.7 billion on account of a jump in inflows from multilateral creditors. FDI was down 13% in 2019, reflecting a slowdown in investment across the region. FDI inflows to Morocco fell to $1.4 billion, half the 2018 level, declined by 18% in Tunisia, to $817 million, in tandem with slower economic growth, and fell 16% in Lebanon to $2.2 billion, with investors deterred by the ongoing macroeconomic crisis. Egypt remained a bright spot, with FDI inflows rising 11% to $9 billion in response to economic reforms that improved macroeconomic stability and bolstered investor confidence. A significant share of these flows went into the oil and gas sector, but telecommunications and consumer goods also attracted investment. Figure 12. Debt and equity inflows, 2010-2019. The 46% drop in long-term debt inflows in 2019 was driven by the collapse in flows from private creditors to Lebanon and, to a lesser extent, Egypt. The economic and financial crises in Lebanon led to a sharp contraction in debt flows from private creditors. Those to public sector borrowers fell to $0.3 billion, one-tenth the 2018 level, and comparable flows to non-guaranteed private sector borrowers turned negative, recording an outflow of $5.4 billion from an inflow of $5.7 billion in 2018. Long-term debt inflows to Egypt, the region's largest borrower, fell 15% to $14.6 billion, but its share of the region's total long-term debt inflows rose to 94% from 60% in 2018, largely on account of outcomes in Lebanon. Driving the downturn was a 42% reduction in disbursements from bilateral creditors and sharp drop in those from commercial banks to $1.3 billion from the 2018 all-high of $6.3 billion. These offset the 2019 record level in new bond issuance of $7.9 billion and $4 billion disbursement of the final tranche of the $12 billion IMF 2016 Extended Fund Facility for Egypt package. Net long-term debt flows to Jordan fell to $0.8 billion, a little over half the prior year level, largely on account of a $0.6 billion outflow to bondholders. In contrast, Morocco saw long-term debt inflows surge in 2019, rising nearly tenfold to $3.8 billion due to the first international bond issuance in 5 years, a €1 billion 12-year offering with a coupon of 1.5%, $1.3 billion in net inflows to public sector borrowers from commercial banks, and a $1.2 billion net inflow from multilateral creditors led by ramped-up lending from the World Bank. Long-term debt inflows to Tunisia rose 75% in 2019 to $1.8 billion, propelled by a net inflow of $0.9 billion from bilateral creditors and $0.4 billion from commercial banks to non-guaranteed private sector borrowers. Figure 13. Net long-term debt inflows, 2010 to 2019. Figure 14. Debt ratios for select countries, 2015 and 2019. External debt ratios are on a rising trajectory for most countries in the region. Historically, the ratio of external debt to GNI and to exports for countries in the Middle East and North Africa was low on account of robust export earnings and the relatively high share of equity in net financial flows. In recent years, however, a rapid rise in debt-creating flows has eroded equity's share. In 2019, equity inflows accounted for 48% of aggregate net financial flows as compared to an average of 80% in 2010 to 2012. This, coupled with the downturn in global oil prices and contraction in other export earnings, has led to an appreciable rise in the average external debt to export ratio. It doubled between 2010 to 2019 from 58% to 116%. The external debt to GNI ratio has also climbed sharply over the same period from an average of 17% to an estimated 28% at end 2019. The averages also reflect Algeria's very low external debt to export and debt to GNI ratios, around 13.9% and 3.3%, respectively, at end 2019, masking elevated debt burdens in other countries in the region. Lebanon's end 2019 external debt to export ratio was 352%, Egypt's reached 210%, and for Jordan and Tunisia it was 192%. Lebanon and Tunisia recorded the highest external debt to GNI ratio at end 2019, 145% and 101%, respectively. The comparable ratio for Egypt was moderate, 39% at end 2019, but on a rapidly rising trajectory, up from 15% at end 2015. South Asia. The 74% increase in net financial flows to $119 billion in 2019 was driven by the steep rise in debt and equity inflows to India. Net financial inflows to other countries in the region rose, on average, only 3%. Table 5. External debt stock and net financial flows, South Asia, 2010 to 2019. Net financial flows to India more than doubled in 2019 to $97 billion, overshadowing the marginal, 3% increase to those to other South Asian countries, and was propelled by debt and equity inflows. Net debt inflows to India rose more than threefold to $40 billion. Half of these were long-term inflows from commercial banks to non-guaranteed private sector entities, largely intercompany lending in response to relaxation of investment barriers, including in the retail and insurance sector. Additionally, a surge in new bond issuance by public and private sector entities pushed the net inflow by bondholders to $13 billion, compared to an $8 billion outflow in 2018. Net debt flows to other countries in the region fell, on average, 3%, driven by a 43% drop in long-term debt inflows to Pakistan and rise in principal repayments to bondholders and bilateral creditors. In contrast, net debt inflows to Sri Lanka rose 53% on account of the $4.4 billion sovereign bond issues in 2019. FDI inflows remained resilient, rising 11%, boosted by a 10% increase in inflows to India to $43 billion, directed largely at the technology and communication industry. FDI inflows to Bangladesh also rose 5% to $1.3 billion, mostly into the garment industry, and inflows to Pakistan rebounded to $2 billion with investment in energy, textiles and the financial sector led by British and Chinese investors. India also benefited from a surge in portfolio equity inflows to $14 billion, from an outflow of $4 billion in 2018 driven by attractive valuations and improvements in market access, raising total net equity inflows to India by 63% in 2019. Figure 15. Net debt and equity inflows, 2010 to 2019. South Asian countries other than India owed, on average, 83% of long-term external public debt to bilateral and multilateral official creditors at end 2019. Their external public debt stock of $162 billion at end 2019 comprised of $73 billion, 45%, owed to multilateral creditors, $62 billion, 38%, to bilateral creditors and $27 billion, 17%, to private creditors, bondholders, commercial banks and other private entities. At the country level, the composition of external debt stocks varied. In 4 countries, Afghanistan, Bangladesh, Nepal and Pakistan, multilateral creditors accounted for over 53% of end 2019 external public debt, including Bangladesh 66% and Nepal 87%. In contrast, Bhutan owed 74% of its external public debt to bilateral creditors. 3 countries, Maldives, Pakistan, classified as a blend IBRD-IDA, borrower creditworthy for some market-based financing, and Sri Lanka, an IBRD borrower, have issued bonds in international capital markets. Private creditors accounted for 35% of Maldives' external public debt stock, 13% for Pakistan and 48% for Sri Lanka. The World Bank was the single largest creditor, $38 billion at end 2019, equivalent to 23% of long-term public debt stock, followed by China, $33 billion, and the Asian Development Bank, $30 billion. Figure 16. Share of external public debt stock by creditor composition, end 2019. Across the region there is a significant divergence in debt burdens. On average the ratio of external debt to GNI and to exports remained moderate, an average of 20% and 117%, respectively at end 2019. But India's economy dwarfs that of other countries in the region and its GNI and export earnings, 22% and 98% respectively in relation to end 2019 external debt stock were the key determinant of these ratios. Bhutan had both the highest debt to export and debt to GNI ratio at end 2019, 330% and 117%, respectively. Debt in relation to exports 285%, and GNI 69%, was also elevated in Sri Lanka. Pakistan's external debt to export ratio was 324% compared to 126% for Bangladesh and 72% for the Maldives. The external debt to GNI ratio of Bangladesh remained low, 18%, and moderate, 37%, for Pakistan but rose to 53% in the Maldives, double the 2015 level. The regional average for the ratio of international reserves to external debt, 64% at end 2019, was also heavily weighted by India, which had reserves equivalent to 77% of external debt stock. This ratio varied considerably for other countries from 56% in Bangladesh to an average of 12.5% for Pakistan and Sri Lanka. Figure 17. External debt indicators, end 2019. Sub-Saharan Africa. The increase in financial flows to the region in 2019 by 11% was dragged down by an outflow of portfolio equity from South Africa. These offset FDI inflows, which rose on average 23%, and net debt inflows, which were up 35% over the prior year level. Table 6. External debt stock and net financial flows, Sub-Saharan Africa, 2010 to 2019. Net financial flows to the region in 2019 were a mixed bag, a 35% rise in net debt inflows offset by a 24% fall in equity inflows. South Africa, the region's largest debtor, drove these outcomes. Debt inflows rose to $4 billion from an outflow of $0.9 billion the previous year, largely on account of the $5 billion sovereign Eurobond issue in September 2019, the largest offering to date, with a $2 billion 10-year tranche and $3 billion 30-year tranche with a coupon of 5.75%. But it was a different story in regard to equity, where heightened risk perceptions and more attractive options elsewhere led investors to retreat from the South African market, resulting in a $4.3 billion outflow of portfolio equity as compared to the $2.9 billion inflow recorded in 2018. Net debt flows to other countries in the region rose 20% to $41 billion from $34 billion in 2018, propelled by a 44% rise in net inflows from multilateral creditors led by those from the World Bank, which rose over 52% to $9 billion. FDI inflows to the region were up 21% in 2019 to $23 billion, with much of the increase attributable to a slowdown in divestment in Angola's oil sector. FDI inflows to the country remained negative in 2019, minus $4.7 billion, but less so than in 2018, minus $7.1 billion. FDI inflows to Nigeria rose 81% to $3.3 billion, with some diversification from the oil sector, and were up 71% in Côte d'Ivoire to $1 billion, in tandem with the country's sustained economic growth, while those to South Africa were up 8% to $1.5 billion. Figure 18. Net debt and equity inflows, 2010 to 2019. The external borrowing patterns of many countries in the region has changed significantly over the past decade with increased reliance on non-traditional bilateral creditors and private creditors. This evolution in the creditor composition of debt flows is particularly strong with respect to the 33 poorest countries in the region classified as IDA only. New debt inflows, i.e. disbursements from long-term loan commitments, to these countries totaled $31.8 billion in 2019, 15% higher than the prior year and over 2.5 times the level at the start of the decade. Over this period, private creditors' share of disbursements increased from 9% to 32% in 2019, largely on account of bond issuance in international capital markets led by countries like Côte d'Ivoire, Ghana and Senegal, but also reflecting renewed lending from commercial banks, often facilitated by guarantees from bilateral export credit agencies or multilateral institutions. The rise in lending by private creditors has come largely at the expense of lending from official bilateral creditors, whose share of long-term disbursements fell from 27% to 15% over the same period. Loan disbursements from IDA were $5.5 billion in 2019, double the 2010 level, and IDA remained the single largest creditor. Figure 19. Disbursements to IDA-only countries by creditor composition, 2010 and 2015 to 2019. Figure 20. External debt to GNI for select countries, 2010 and 2019. The rise in external debt outpaced economic growth in many sub-Saharan African countries over the past decade, and borrowing terms hardened. From 2010 to 2019, the GNI of countries in the region rose on average 3.1% per annum, measured in US dollar terms, while external stocks increased, on average, 9% per annum in the same period. The terms of new long-term external loan commitments to public sector borrowers also hardened, reducing the average grant element to 13% in 2019 compared to 28% in 2010. The combined ratio of external debt to GNI averaged 38% at end 2019, a marginal change from the prior year, but a rise of 62% over the comparable ratio of 23% in 2010, and the average masks some significant increases in the ratio at the individual country level in both absolute and percentage terms. In Zambia, the ratio of total external debt to GNI rose from 22% at end 2010 to 119% at end 2019. In Rwanda it tripled from 20% to 62%, and in Uganda it rose fourfold from 11% to 41% over this period. The ratio of external debt to export earnings followed a similar trajectory. It averaged 152% at end 2019, up from 137% in 2018 and over double the comparable ratio at the start of the decade. The average ratio masks the fact that in over 30% of countries, including many that benefited from HIPC and MDRI, the end 2019 external debt to export ratio was close to, or above, 250%.